Hey everyone, welcome to a new episode of SCR Finance's podcast, Cash Chronicles.
Hi, I'm Ryan.
Hi, my
Go
name
for
is
it.
Serena,
And my name is Ken.
And so today we'll be talking about something a little different.
which are credit scores.
Now, in today's financial world, a
Jesus.
credit score is one of the most important numbers in a person's life, even though it's just a number. Whether you're applying for a mortgage, car loan, or even a credit card, your credit score often determines if you're approved, how much you can actually borrow, and what interest rate you'll pay on those types of loans. But with a good credit score, while a good credit score is important, it's not the only factor that lenders consider. For example, even with a perfect score, you won't be approved for a mortgage if you don't have a steady income, other requirements. Still, understanding credit scores is essential for anyone looking to build a strong financial foundation.
So, thank you, Ryan. That brings us to the question, what is a credit score? A credit score is a three-digit number that represents a person's creditworthiness, basically how likely they are to repay borrowed money. And this number is generated through a detailed analysis of an individual's credit file, which is compiled by credit bureaus such as Equifax and TransUnion in Canada. Lenders use this score to evaluate the potential risk of giving someone credit, and this helps them determine whether to approve or deny a loan, and what interest rate to offer, and finally, how much credit to extend.
Thank you, Serena. So now we're going to talk about some of the factors that do affect a credit score. And credit scores are calculated based on five main categories, and each of them are rated slightly differently. So the biggest one by far is payment history. And this basically looks at, if you paid your bills on time, if you have any later missed payments, accounts and collections, and bankruptcies. And if you do, they all negatively impact your credit score. And in the case of bankruptcies consumer proposals, they will probably be a no-fly for the bank to extend you any credit. The second one is looks at how much of your available credit that you use. So credit utilization. This is weighted at 30%. And this looks at basically, again, how much of the available credit you're using. And as a general rule of thumb, banks don't want to see you using more than about 30% of your credit. If it does, it looks like, you're irresponsible. So, for example, if you have a $10,000 credit limit across all your credit cards, you really shouldn't be using more than $3,000. Third is length of credit history. That's weighted at 15%. And as a rule of thumb, longer credit history is better as it gives lenders more information to judge about how you manage your credit over time. And that's why they say, if you had a credit card from when you're 18 and you're 40 now, don't go close your credit card from when you're 18 because it will drop your credit score. Fourth is credit mix, and lenders like to see a variety of credit types, excuse me, like credit cards, auto loans, student loans, line of credits, mortgages. And that really just goes to show you that you can manage different types of debt responsibly. And finally, this is weighted the least. New credit slash recent activity. This is only 10%. And every time you apply for a new credit card, lenders usually do a hard check on on your credit report, which can lower your score slightly, just in the short term. And again, opening too many accounts in a short time can make you look risky to lenders because they will wonder, oh, why is this guy trying to open so many credit cards? Looks like he really needs money. I should deny him. Something to those lines. But that being said, when you're shopping for rates, if you do multiple hard inquiries within a certain period of time, I think 14 days, it just counts as one hard inquiry on your credit report, no matter how many hard inquiries there are in that period of time.
Awesome, Ken. Now, you just talked about things that affect your credit score, but there's also a lot of things that don't affect your credit score. And there are many common myths about what affects credit scores and what don't. And so here's a lot of things that don't impact your score. Number one is personal information like your race, religion, gender, marital status, or your age. Although age does affect it a little in terms of your length you've been holding your credit score for. Another one is your income or whether you've had a recent pay cut. The third one is interest rates on your loans or credit cards. Checking your own credit report, which is a soft inquiry that has no effect. Being denied credit cards does not actually lower your score either, although most vendors do hard checks, and this does lower your score. Using a debit card or making rent and utility payments, unless they go to collections, Also, bounce checks or overdrafts from your bank account don't impact your score. Credit counseling or applying for non-credit related services like phone plans or rental housing don't affect your score, and expired information that is no longer on your credit report don't affect it at all.
Okay, great. Thank you, Brian. So now let's go into credit score ranges in Canada. And in Canada, credit scores range from usually 300 to 900, with higher scores indicating better credit. And here's an example of some of the credit scores from Equifax.com. Equifax uses a system from 300 to 850, and there is a specific range of credit scores which go into 5 different categories. First of all is from 800 to 850, which is considered to be an excellent credit score. Individuals in this range are considered to be low-risk borrowers, and therefore, if you are someone who has a credit score 800 or above in this case, you're most likely to get the best possible interest rates and easiest loan approvals. Next is from 740 to 799, which is considered to be a very good credit score. And individuals in this range have demonstrated a history of positive credit behavior and may have an easier time being approved for additional credit. This is pretty good as you're seen as a low-risk borrower and you're seen as a low-risk borrower. Next is from 670 to 739, which is a good credit score. Lenders generally view these with credit scores of 670 and up as acceptable or lower risk borrowers. And then afterwards is from 580 to 669, which is a fair credit score. And lenders might consider these people to be higher risk and they may have trouble qualifying for new credit. And finally, from 300 to 579 is considered a poor credit score. And individuals in this range often have difficulty being approved for new credit. And if you find yourself in the poor category, it's likely you'll need to take steps to improve your credit scores before you can secure any new credit.
Thank you, Serena. So as can be seen, having a strong credit score opens a lot of financial doors for you, right? And a high score means that you're more likely to be approved for loans, get better interest rates, and have higher credit limits. And in a lot of cases, it can affect your ability to rent an apartment because landlords like to do credit checks on their own. And in some industries and for some jobs, having poor credit scores and general financial issues can cause issues. However, it is also important to note that a credit score is not everything. And especially in recent times, lenders also care about your income, especially when they're extending more serious types of debt like mortgages and car loans. And this is because income plays a very significant role. And if you get those loans, lenders want to look at your tax returns and based on averaging the last few years of income, they decide how much credit to extend you. And I'll talk about a specific example, mortgages. In mortgages, banks like to use something called GDSR, gross debt servicing ratio. And that basically looks at how much of your gross pre-tax income is going towards paying all your housing expenses, mortgages, utility bills, property tax, etc. And as a general rule of thumb, most lenders do not want you to exceed 32%, although a few percent here and there can be, exceptions here and there. So as an example, let's say you make $8,000 monthly. That would mean that you have about $2,500 to play around for, all your monthly housing expenses. And as an example, a $400,000 mortgage with an average of a 4.5% interest over 25-year amortization period, which is basically you need 25 years to pay down the principal and the interest. That runs you about $2,200 monthly, and then you still have to pay for property taxes, utility bills, and the like. Just something to think about.
Okay, great. Thank you, Ken. So you might be wondering now, how do I improve my credit score? Well, there are many ways to do so. First of all, you can use credit wisely, as Ken said, and don't go over your credit limit. And as Ken said, if you had a credit card with a $5,000 limit, try not to go over that limit because borrowing more than the authorized limit on a credit card may lower your credit score. And because of this, if you use a lot of your available credit, lenders see you as greater risk. And this is true even if you pay your balance in full by the due date. Second, though, you can consider improving your credit history by having a credit account open and in use for longer periods of time. Your credit score may be relatively lower if you have credit accounts that are relatively new. If you transfer an older account to a new account, credit bureaus consider the new account as new credit. For example, some credit card offers come with a low introductory interest rate for balance transfers, and the new card on which you transfer your current balance is considered a new credit product. Consider keeping an older account open even if you don't use it, and use it from time to time to keep it active. Furthermore, you can limit your number of credit applications or credit checks, because credit inquiries, also known as credit checks, count towards your credit score. And it's normal and expected that you'll apply for credit from time to time. When lenders and others see a credit bureau for your credit report, they record it as an inquiry. And if there are too many credit checks in your credit report, lenders might think that you're urgently seeking credit or trying to live beyond your means, which lowers your credit score. Okay, and now, how do you check your credit score? In Canada, you can check your credit score in a report from official bureaus like Equifax and TransUnion. If there's derogatory information on that report, you're allowed to file a request with the credit bureau to review and remove the score where applicable. There is also free tools like Borrowwell and Credit Karma, which provide updated scores and tips on how to improve your credit.
Your credit score is a powerful tool that can influence many parts of your financial life, from getting approved for a car loan to securing a better rate on your future mortgage. But while it doesn't have everything about your financial health, maintaining a good score by paying your bills on time, using credit wisely, and monitoring your report regularly is one of the best things you can do to stay financially strong. Just remember, credit scores aren't the whole story of your financial life, but they're definitely a key part of it. Think of your credit card or your credit score as a financial passport. It opens doors and makes your journey easier, but it's still your overall planning and financial responsibility and discipline that determines where you ultimately go.
Okay, thank you,
And
Ryan.
that's a wrap. So that's it. Thank you for listening to this episode. My name is Ryan.
My name is Serena.
And my name is Ken. See you next time.